Good morning, everybody. The date is 8:20 a.m. Pacific Standard Time, 1/18/2016. U.S. markets are closed today due to Martin Luther King celebration. It's a holiday now, so we're going to have a 4-day shortened week. We've got corporate profits that are coming out here in the earnings season. This movement that you all are witnessing right here, I'm going to draw a trend line on this daily chart. And right there is where this Dow has sold down significantly in the month of January year to date. From that time frame is one of the worst actually the worst January ever. And we said that these markets were going down. And when we said they were going down, we meant it. We meant to tell you people that we are in the beginning of a bear market. 2015 and 16. Update 3.5 of 2015. We also have an older one too, but we'll just deal with this one here. And when we say super bubble, we mean it. And you know what? What has happened in the US is that these markets on a short-term basis only are oversold because that's how the math rings. So when you're in the beginning of a new bear cycle, nothing goes straight down forever. So what it really means is that we are oversold. We're going to get a bounce before we make a lower low. And this was the current lows right over here on this daily chart, right around 15,500. That's almost a two. Buddy, we go down there and test that. That'll be a 2,000 Dow point drop. Finito. You heard what I said. I'm not joking about it. It's here to stay. Earnings season is starting. Now, let me show you something. Right over here, this green line is referred to as a 200-week moving average. And a 200-week moving average is extremely important. Now that we've oversold, any movement back up in the volatility, I'm going to draw a trend line right there. That's where the high was on the Dow. The same thing on the S&P. And when we really take a look at the longer term, we're going to go all the way back here, 2013. It's going to be from 2013. This is where the bull market, short-term bull market started. That's where it started. It hasn't looked back. And it was one of the biggest pump and dumps that U.S. history as we continue to move. One of the things about the weekly, once again, I just want everyone to understand that this is the worst for the Dow Jones Composite in the month of January. We will be doing our yearly formulas here in January. That's the only time that they can be done. But I will tell you in this first period of time in January for an opening calendar year is this is nothing but big money selling, and that these markets were pump and dump. The fundamentals in the U.S. economy do not support a Dow at 18,000 plus. I'm just sorry, the numbers don't meet, they don't match from a fundamental perspective. It might in the people who are pumping and dumping it, but quarterly earnings are starting tomorrow, man, and they're coming out heavy duty. And yes, short term, oversold conditions get a bounce before they make their next bigger low. And that's just how um, these markets work. And the writing is on the wall. one of the things that we're going to show you on a monthly calendar level. Just remember that 200-week moving average is the wall of support for the Dow. This is a monthly Dow. And basically, right here, like I said, we're almost down 2,000 points intraday. This is a double bottom that we are having here. Now, here's one of the primary key factors. Back in year 2015, we were extremely overbought. But now we have a short-term oversold. Yes, markets will move up higher because of that. It's called a dead cat bounce. But this January move is going to be part of the full year of 2016. That means one thing. We have a long ways. This is a major support level that was over here in the 2014 where my pointer is. And this is where we had started with a rally that went straight up. We made our highs at double monthly tops. We had a big downside movement. They came back in. So when this was an oversold environment, we went up. But now we're still in an oversold environment as of year to date right now, but we're not going to see where it's going back like this from oversold to overbought. That's just not going to happen fundamentally. And meaning that there's a long ways to go down here, and that's going to be 15,364 on the Dow Jones on this monthly chart. And not only that, I am going to be doing a separate video about year 2016. We are going to start reporting earnings tomorrow. And these companies that release their corporate profit are going to create an extreme volatility area. We are oversold for one of the first times going into a major earnings season. And we got IBM, we got Netflix, we've got more volatility that is going to hit these markets. The market sold down in anticipation of a worse quarterly earnings releases. I know what the cash value is on the Dow. I know what the cash value is on the S&P 500, and they're not near anything that we have seen, and they haven't. And not only that, people, when I say volatility, you think we had volatility? You haven't seen nothing yet. And this is for the rest of this year. And not only that, we're in recessionary environments and some of the key sectors of the U.S. economy. Hey, knock, knock. Anybody home? Hello? Well, you know what? If you're an investor, whoever you are, you know you can't handle volatility. And you know that even the so-called professionals can't handle volatility. Well, I tell you what, we love volatility. And we love markets getting washed out. And we love all of that because we are short going down to make money. At the end of the day, at all of the misery, we're making money on the other side of all of the misery that people are experiencing. So goes as the rest of the misery of this calendar year. Just remember, we're getting paid. So
Yes,
we love it when people are crying about markets because they're on the wrong side. This is the
and they see us
volatility,
smiling.
the recessionary ISM, the PMI, Purchasing Manager Index, there's a lot of other key indexes in here. But I will just say that, listen, because of the amount of selling, we're going to have an upside move. But when the upside move comes, it's going to reverse before it makes another lower low. This is the low right down here, right below 15.4. We're at 15.98. 8 where we closed. And the downside, what people don't realize, yeah, we closed 390 points down on the last trading day, um, but we were down intraday 537 points on the Dow. And basically, rightfully, is that these markets never were to be up here anyway. So I'm going to give you, here's what I want people to know. On the last calendar trading day, which would have been just today's a holiday. So what you need to know is that this bar, monthly bar, that was a 512 movement down on the last day. That's 512 points on the Dow Jones. So when I say things are going down, you'll learn to listen. Because if you don't listen, you'll listen from your wallet. Yeah, and you heard what I said for the people that are watching the video and will be watching it. And if you're not smart enough to listen, well, then you deserve to be taken to the woodshed. And yeah, we do give out pieces of free economic data and a little bit of interpretation as to what's going on. And for you people that didn't sell, you think that buying and holding forever is going to work? No, it's not. That's not making money. Making money is knowing when to sell out with your profits and get back in. So we're oversold on a monthly level, and we will have a bounce to go higher in the Dow and the S&P and the Nasdaq Composite. But here's the key that none of you know. Yeah, we do get a bounce, but we are in a monthly sell signal on this Dow. Percent DS is 11.34. You can bet we're going up from this point starting tomorrow. We will go up before we make lower lows. Lower lows include that if you take a look back here where my pointer is at the 2009 area, give me a break. Give me a break. So you're going to bounce before we start getting down to where the 2013 highs were over here. Here, let me pull this up so you can see it. Now, here's what you can take a look at. This is in Cali, that trend line right here. You heard what I said. This trend line here, that's where we're going. And once we go there, we're going to see what kind of support will be down there. We're not going to go there right away, but we are going to the 2014 lows here that were on this date. And that was February of 2014. And a year ago in 2015, February, the month of February came around and we went up. And that's this month that I'm going to show you over here from the daily to the monthly. So just remember, it takes on the weekly 4 weeks. And then, of course, on the daily, it takes 20 days. So we are going to be coming down to this trend line. The support line is 15.98 and 15.88, and this is on a daily. And there is a daily 200 daily simple moving average that I wanted to point out is that green line. And as we move all the way back over here, uh, this green line on a daily, that's a 200-day simple moving average. There's a death cross. The death cross will stay with these markets. And when I say that, what does it mean? You want to know what it means? The 50-day is a death cross moving average crossing over a 200-day moving average. The white line or beige line is a 100-day moving average. Every one of these 10, 120, they're all crossing over, which these markets have not seen. That means that this on the Dow, that all of these daily simple moving averages, you got the 50 crossing over, the 200-day is so far below the market right now. This line here is a 10-day. This one up here, the 20-day, the red line, crossing over a 100-day. The market technically is horrible. However, nothing goes straight down. There will be a bounce up. When we hit our resistance levels, these markets are going to continue to make lower lows throughout the rest of this calendar year. Let it be known on this very day that you've had an opportunity to accept this, or you can deny it, or you can gamble with it. We're at the end of the commentary now. These markets are totally torched.